Ladies and gentlemen, friends, skeptics, and fellow survivors of the ever-baffling world of real estate appraisal, welcome. Today, we embark on a noble endeavor, attempting to decipher, digest, and if the stars align, make sense of what Fannie Mae actually wants from us appraisers. Now, for those of you who have spent years navigating the twists and turns of appraisal guidelines, you may feel like an old prospector panting for gold in a river of regulatory silt. Just when you think you've struck pay dirt, with a firm understanding, someone upstream dumps a fresh load of updates and you're suddenly back to sifting. But fear not. We have with us a man whose native language is Fannie Mae and he speaks it fluently. I'm talking about Lyle Radke. Lyle is here not to bewilder, but to enlighten, not to mystify, but to clarify, not to torment, but dare we say to assist. He will help us cut through the fog of guidelines, updates, and expectations, ensuring that we, the hardworking appraisers of the world, know exactly how to meet the demands of modern lending without losing our sanity or what's left of it. So sit back, take notes, and brace yourselves for an illuminating conversation. By the end of this session, you might just walk away a little bit more informed. Lyle Radke, thank you for being here with us today. I am absolutely tickled to have you on the line. We have a lot of people in the room today. I do want to say to the folks in the room, we have a crew of people screening questions since we have so many people in the room. And Lyle and I will respond to specific questions that they send to us. So that's how that's going to work. We're going to be using the Q&A for the questions. If you have a question you want us to address on screen, you can send that to the Q&A, and the panel of folks that are screening the questions will forward the ones that we can get to. If we don't get to your question, we'll try to get an answer somewhere in the process that satisfies you. Lyle, I'm going to go ahead and turn the stage over to you and let you do your presentation on market condition adjustments. I know that a lot of appraisers are really concerned about market conditions. There's some confusion out there in the world. So go ahead, and I may interrupt you along the way.
Al, thank you for inviting me, and I think this will be a great opportunity to have a discussion about this policy. I want to say a couple things just from the outset. First of all, I'm starting to get that droopy, jolly face. I want you to know I'm smiling on the inside, even though whether or not it looks like it on the outside. We have a legal disclaimer that I'm required to show you. And I'll put that up there. You can read it. But essentially what it says is we have a selling guide policy. And that is the contract that Fannie Mae has with our lender customers. And that's the rules, right? That's the rule book. I will try and be consistent with the selling guide and what I say. But if you identify any inconsistencies, you need to go with the selling guide. All right. So when we talk about market condition analysis and market condition adjustments or time adjustments, I think it's helpful to understand a little bit of the background about who is Fannie Mae and why do appraisals matter to us. You can read the history of Fannie Mae if you want, but I think the important thing to know is we are not a regulatory body. We have no police powers. We're a business. We're a business we're kind of a unique business in the sense that we have a congressional charter. So our mission or our business footprint is defined by law, by Congress, right? And what we do is we exist to support what we call the secondary market for home financing. And this has its roots back in the Great Depression. The government created Fannie Mae back in, I think it was 1936, roughly, as a way of reviving home lending during the Great Depression. And I won't go into all the details. Of course, we all remember the Great Depression, right? And we've all seen It's a Wonderful Life and how home loans were made back then and how cash flowed and how difficult it was during the Great Depression to keep a bank or savings and loan open. So what Fannie Mae does essentially is we buy the rights to the future mortgage payment from lenders. And in exchange for that, we guarantee payment of that mortgage. So we're going to take this stream of income from a mortgage payment, a 30-year mortgage, 360 payments. That's 360, incomes. And we're going to securitize that, which means we're going to borrow against it. We go to Wall Street or wherever, we go out into the public capital markets, and we borrow money and we pledge the future income from these mortgages to pay back that debt. And then we turn around, we take that money we've borrowed and we use it to buy additional mortgages, right? And we charge lenders a guaranteed fee for this privilege of offloading their mortgage risk and their mortgage income to us, right? So in all of these transactions, as this money flows back and forth, we're trying to connect money from people who are savers, and that might include, individual folks who have their money in a savings account. It might include like firemen and policemen and teachers, people who have pension funds. Those pension funds get invested in this way. Individual savers in their IRAs or their 401ks, people who have money saved, who want to earn a steady rate of return, can lend it to Fannie Mae by buying our bonds, right? And then we'll take that money and lend it to banks or give it to banks in exchange for the rights to these mortgages. When we acquire a mortgage from a lender, the pricing on that mortgage is anchored to what we call the loan-to-value ratio. So there's a certain amount that's been lent, and then there's a certain amount of capital. These are all, a mortgage loan, as you know, is a secured loan, meaning the property is the security that has been offered to guarantee payment. So if the borrower fails to make their payments, then they've agreed by contract that their house can be sold to satisfy that debt, right? And so we want to know, how much can that house be sold for? And if the amount of the mortgage and the amount of the value of the house are very close together, then that just may not leave us very much wiggle room in order to pay the costs of managing that foreclosure, right? So we would charge a larger guarantee fee when the LTV, the loan to value ratio, is higher. If that loan to value ratio is very low, then we would charge a lower guarantee fee. So you think of it kind of like an insurance model. If you're trying to insure my 21-year-old son for driving an automobile, you might charge a different premium than if you're trying to insure me, right? We have different age, and we know that age correlates with driving success, and we have different experience and different track records. So it's very similar to that, right? But the important thing here for this audience is value is the denominator in our pricing model. Every single loan that we acquire, we want the very best value that we can get, because that helps ensure that we operate in a safe and sound manner, that we're pricing our risk appropriately. So value is super important to us, right? Now, whether or not it's equally important to all parties in the transaction, I don't know. You can judge for yourself. But to Fannie Mae, the value is critical, and we want to get the value right. It not only affects loan pricing, but it affects eligibility, right? If the loan to value is above 97, we can't acquire that loan. It's outside of our charter, right? Or it's outside of our current policy. I think our charter is actually 100%, but our current policy is 97%. And if the loan to value is above 80, then our charter requires that we get what we call a credit enhancement. And you know this as mortgage insurance, PMI, right? So if that value is wrong, we may fail to get mortgage insurance when we should have it, right? So it's really super important that we get the value right. Then when we try and securitize these loans, there's some of our transactions, like on your screen, you can see credit risk transfer. In a credit risk transfer, again, the LTV is critical. And the companies that are buying those or paying us for that credit risk transfer, they're going to take on the first loss position. So that means if there's a default, they're going to be the ones who lose money on the margin. And so it's really important to them that the value be accurate so they know the amount of buffer that they have, and they can help predict their risk, right? So all the way through this process, the value is super important to our business model. And getting that value right is how we operate safely and soundly.
Right.
So
before we move on to the next slide, Lyle, I want to go back to kind of the notion of what it is Fannie Mae does. And if I'm hearing you correctly, there was a time back in the day, I'm thinking of when I bought my first house. I borrowed the money from a local bank, and I got a payment stub book, and I sent my payments to that bank. They serviced the loan, which means they've got that money personally tied up. What you guys are doing are buying those loans from banks so that they then have capital to go out and work with. Is that a fair?
that is correct.
Okay.
They may still service the loan, but they're acting as a pass-through. They're collecting that money from you, and they're sending it to us.
Okay, so you're providing the liquidity to the lending institutions to keep operating.
That's right.
Okay.
And there's I don't know how many just for Fannie Mae alone, we have a $3.6 trillion portfolio. So that means $3.6 trillion in outstanding mortgage debt that we own. And if we were not here in the marketplace, that means that lenders would have like $3.6 trillion tied up in existing mortgages that they could not lend. It's illiquid, right?
Yeah. That money's not out there working for them, and that's how they make their living, basically.
Right. And that would raise the interest rate and the cost of financing for everybody across the board, because it's a supply and demand problem. If you don't have enough supply of available money to lend, then you have to charge more for the money that you do lend.
Right. And then the next question I have is, and again, we're kind of covering basic topics right now, and we're going to get into market condition adjustments in some detail here in just a minute. But the value part in the LTV, the denominator, the value, that part is critical to you guys and to the people you're selling the mortgages onto. There are two parts of the risk analysis. You've got credit risk and you've got collateral risk. And the collateral risk, and again, this is like fundamental real estate appraisal thought process. But the reason the value is so important, and what you said earlier, and I want to drive this point home because I think it clarifies for appraisers what it is we're doing. That value number ensures that if something goes wrong on the credit side, or the person who owes money on the mortgage loses their job, that collateral can satisfy the indebted part of it. Is that right?
That is right.
Okay.
Now you can point to some assumptions or some factors that are not static in this model. For example, the value of the property today is not necessarily what the value might be, let's say 2 or 3 years from now, if there's a default.
Right.
Most people don't default on day one, and most defaults don't take a minute to process it. It's a process that takes time, right? So we're not asking the appraiser to project into the future what the value might be at some future date. That's a risk that we take, and we have economists who look at that and kind of factor that into our pricing model.
Right.
So we just want to know the value right now as a good starting point.
There you go. Okay, good. Thank you.
So when we talk about this will be a little bit of an abrupt change here, but just to get right to the topic at hand, time adjustments can have a significant impact on the value, and certainly on the process by which the appraiser defends the value, or in other words, the credibility of the value. We recently went through a period of time, 2020, 2021, 2022, where home prices appreciated very rapidly, historically very rapid appreciation. Nationwide, I think it peaked at somewhere around 20% annually, right? Now, when we look at how much that market was changing, and then we compare that to how much appraisers were adjusting for the market change, we see some disparity, right? And that's what you see here on this slide. And that's really the reason why we took a closer look at our policy. We've sort of inferred from this data that our policy is ineffective. So we made some changes to our policy to try to make it more effective. But the green line here is the home price index, and that you could use as sort of a prediction of what a time adjustment should be. Now, you can argue about whether or not the home price index is accurate or reliable, particularly at the local market. But on average, across all markets, it is probably reliable. It's probably the best indication you have of what the average time adjustment should be. So hold on one sec. I got to fix something. Yeah, I moved my laptop and I forgot to plug it in, and I just got a battery warning. So sorry about that. So like I was saying, on average, this green line is what you would expect the time adjustment to be if we were just basing it on economic data, right? On markets, what the markets are doing. The blue line is the actual time adjustments that we saw from appraisers during that time period. And you can see the blue line is very flat. The gap between the blue line and the green line is basically error that's introduced into the valuation assessment, right?
Mm-hmm.
So what this would tell you is that if home prices are rapidly appreciating, let's take kind of the more extreme end of the range here. Let's say this was 25% annual appreciation, right?
Right.
We're seeing the appraiser is adjusting about 5%. So they're lagging the market by about 20%. So that means they're going to be underestimating the value by 20%. Well, when we look at values, we find they don't actually underestimate the value by 20%. So they're compensating for this gap between what the data is telling them versus what they're doing by introducing other changes. And I'll give you an example. Let's say that there's a contract price on the property, and the appraiser's looking at the contract price, and they say, you know what, that's a pretty reasonable price. I am very comfortable appraising close to that contract price. Maybe they have a good comp that sort of supports that price, but maybe they only have one. So they're gonna go out and get two other comps that are not quite as ideal, that are a little bit different, right? And maybe one of their options might be something that's physically very similar, but sold 11 months ago, right? So it needs this 20% time adjustment. And they say, well, that's very physically similar. I'll choose that, right? I'll use that. But they don't make the 20% time adjustment. Well, then they find themselves trying to make up ground through other means. So that, let's say that it needs a little bit of adjustment for size. Well, maybe they should that adjustment. Maybe it needs a little bit of adjustment. Maybe it has a swimming pool or something that needs an adjustment. And so they shrink that adjustment. And you find them tweaking all their adjustments so that they no longer represent market reaction, but instead they're trying to back into the value that they're pretty sure they need to have because of that contract price, right? Whereas if they just use the time adjustment, everything would be so much simpler and cleaner, right?
Let me cut in real quick and just ask the question that's rolling around in my head. Why do you think appraisers are so reluctant to employ a time adjustment? Why?
Oh, fantastic question, right? So when I ask appraisers this question, I generally get one of two answers. The most common answer is probably, well, I don't think lenders want to see time adjustments. Maybe they've had a bad experience in the past where they made a time adjustment and some lender pushed back on them and said, hey, are you sure about that? I need to see your evidence, right? And being, having to do rework or having to defend the adjustment, that's painful. So nobody wants to do that. So they're like, I'm just not going to do time adjustments. The other answer that I hear is appraisers sometimes say, well, I don't have enough data to support a time adjustment. I'm afraid I'm going to be wrong, so I'm not going to do it. And we can talk more about that. But my answer would be, Choosing not to make an adjustment is exactly the same as choosing to make an adjustment. You got to defend the zero adjustment with equal rigor to how you would defend any other adjustment. And so, you can't not do the analysis and just say, I'm not going to do it. You have to do it. It's part of the expectation, right? It's part of the profession.
And one of the things that I've heard in talking to appraisers around the country, this speaks to the reluctance to make time adjustments because maybe the bank pushes back on a time adjustment. I think some underwriters don't like to see time adjustments.
I have heard that my whole career, and that is the common perception. Now, when I talk to lenders, sometimes they push back and say, no, that's not true. But you know what? He said, she said. I don't know how to answer that question. What I will say is that that's a good segue to our next slide. And to set up this next slide, that's exactly the question we wanted to answer. So if the problem is that lenders are pushing back on time adjustments, that lenders are the impediment, then we wanted to make it super crisp in our selling guide that time adjustments are the norm. Time adjustments are normal. They're good. They should be expected. There's lots of ways for appraisers to do them, and underwriters should expect to see them. Only challenge them if they look like they're obviously wrong, and you should have some evidence for that, right? But don't challenge something that is intrinsically good. So here's the new selling guide language. And there's two parts to this, right? The first part is we have a section of the selling guide that's called unacceptable appraisal practices. And we added a bullet to the unacceptable appraisal practices, which is failure to make market-derived adjustments, including time adjustments, when they are clearly indicated, is an unacceptable appraisal practice. So now we're staking it out nice and clear for the lender that not making the adjustment is unacceptable.
Okay.
The second piece is what you can see here in yellow. The comparable sales being considered must be analyzed by the appraiser. Must, that's a requirement, to determine if there have been any changes in market conditions. Okay, so now the expectation is the appraiser will analyze for market condition changes, and the lender is now responsible because they're guaranteeing to us that the appraiser has met these requirements. So now this puts the onus on the lender to make sure that the appraiser has done the market condition analysis.
Right, and one of the pushbacks I get on this is an appraiser is working in let's say Nashville, Tennessee, my hometown. They've got a rapidly growing market area, and once they apply all their time adjustments, they've got maybe 6 sales, and their value conclusion is now above the range of closed sale prices. And what I'm hearing from them is they get pushback from underwriters for not bracketing the sales price of the sales. How do we address that?
Well, I think number one is when it comes to market data, the appraiser kind of has to let the chips fall where they may. Like if all of your data is telling you that that's the value range, then that's the value range. And the underwriter, you just have to persuade them. You have to say, look, this is the data. This is what it shows. This is what I have to do. That's my professional obligation. But I do think there's a potential pitfall that appraisers should be aware of. And it goes something like this. When we look across all appraisals, we see kind of a sunny side bias, an optimistic bias among appraisals. Appraisers are sort of naturally conditioned to give an optimistic value for lending purposes. That smooths things over with your clients, right? And so if all of your approach to the business is like this generous perspective, then once you start making time adjustments, then yeah, it's going to blow the top off your value, because now you have to rethink all your other adjustments. Like your square footage adjustments might have been wrong all along. Your location adjustments might have been wrong all along, and you didn't know it because you didn't have this paradigm for viewing the market that you do your time adjustment first, right? Your condition adjustments might be wrong. So once you start making the time adjustments, you also have to go back and revisit all your other adjustments, make sure they are data centric and anchored in market analysis.
Yeah, that makes sense. That makes absolute sense. Okay, go ahead with your presentation.
So now we're getting down to brass tacks here. This is what we are requiring from the appraiser. And you can find this in that's a little bit small print there, but selling guide B4-1.3-09, adjustments to the comparable sales. Time adjustments must be supported by evidence. And the kind of evidence that we will accept is bulleted out here. Home price indices, that's acceptable, right? You may choose not to use them. You may find something you think is more reliable. But from a policy baseline, minimum expectation, if you were to make an argument that the home price index is the basis for your time adjustment, we would find that argument to be acceptable, right, from a policy perspective. Statistical analysis, like there's a million different ways to do this statistically. Modeling, there's some great models out there and tools that use modeling to derive a time adjustment. Paired sales, like this was the technique that I used the most when I was appraising. It's a very direct measure, but you have to be able to back out other impacts on value, right? And there may be other commonly accepted methods. Like, again, all you folks are here on this webinar today from Appraiser eLearning. E-learning education is the key here. And there are a lot of new classes and new educational materials. I've seen some great blogs on this topic. Go read and study and learn all the different ways that you could kind of tease a time adjustment out of a data set. There's lots of different ways, and we're very open-minded. We're not going to prescribe anything, but what we want you to do is go through the exercise and be able to explain how you did it. So that's the second part here. You must summarize the analysis performed. That summary should include your data sources, your tools, whatever tools you use, whatever techniques you used. Okay.
And I want to get into a quick conversation about tools and techniques. And this is a thing that comes up a lot of times in USPAP classes. It also comes up a lot of times in conversations with appraisers around the country about some of the tools out there that they can avail themselves of to illustrate market changes. And that is, there is a USPAP requirement that you have an understanding of how the tool works. You don't have to know all of the ins and outs of the math, but you need to have a baseline understanding of how to do statistics. Does that seem right with you?
That's how I read USPAP. Yes.
Okay.
Let me give you let me caveat that though. Another thing that USPAP requires is for the appraiser to to strive for credibility, believability, right? And if everyone else is using analytics, and analytics are the foundation of these tools, and everyone else can see the truth through this, statistical analysis, and the appraiser says, I don't understand the tool, so I'm not going to do this. Now the appraiser is not credible. People won't believe you and they won't rely on you. And that undermines your business value as a practitioner if people don't really take your opinion as being reliable. So I think the appraiser's between a rock and a hard place here. USPAP says you have to understand the tool. I'm saying if you don't start to use tools and techniques and get rigorous and quantitative about this, then you're not going to be credible, and that's your business is going to suffer. So you're going to have to meet both, right?
Yeah, and at the end of the day, I see review appraisers work off checklists and like, this person checked all the boxes, but I still don't find this report to be credible. Credibility is part of the checklist for passing muster with USPAP. I think that's important to remember.
Well, what you see on this slide is intended to create credibility.
Yep.
Okay. I'm going to make a time adjustment. Maybe my time adjustment is 0. That's still a decision about a time adjustment. I'm going to defend that decision, whatever the rate was that I settled on, by using data and techniques for analyzing that data, and then by describing how I did that.
Right.
And
And I
now
love,
if I do all that, now I become credible, right?
I love the fact that in the must be supported by evidence, and then you've got 1, 2, 3, 4, 5 different commentaries on what counts as evidence. In
And
conversations,
that's an or statement. Like any of the above. It's not all of the above. It's
yeah,
any one of those will work, right?
yeah. And the example, and I think we're going to get to the example here in a little bit of a way to illustrate a market adjustment, support for market adjustment using the graph. That's not the only way. There are other methods and techniques to derive a time adjustment other than just a statistical analysis showing a graph.
Right.
Okay. I think that's key because a lot of people have come to me and asked the question, how do I make a graph that looks just like this graph that Fannie Mae wants me to put in my report?
Oh, yeah. Great segue to our next slide, right? This graph has been a pain in my side. And part of it was just due to the way we announced it. I think the language you used was sort of unfortunate. There was a little typo in there. Let me start with this. We do not require appraisers to make a graph like this or to include a graph like this in their appraisal report. This is not for appraisers, right? You could almost forget about this graph. This graph is for underwriters. Okay, and this is Fannie Mae's effort to educate underwriters about time adjustments and what they should expect to see. And one of the key takeaways here for the underwriter is that the time adjustment is not necessarily static. So if I've got a comp that sold a year ago and a comp that sold 6 months ago and a comp that sold 1 month ago, I may not adjust them all at the same rate. It may not be 3% a month for all 3 comps, right? It depends on what's happened during that time period. And it depends on how much data the appraiser has to kind of narrow that down. So in this particular case, you know, the example is the appraiser's got fantastic data and they're able to track their market movement on a month over month basis. That's not necessarily true for lots of markets. That's not always going to be the case for appraisers. Like this is an ideal scenario. But in this case, what happened is the market went up for the first half of the year, and then it kind of flattened out, and then it went down, and then it went back up. And when that happens, depending on when the comp sold, you'll need a different adjustment rate. And that's what this is trying to convey, right?
And the reason I wanted to dive into this graph as the example, I want to make it clear to our listeners that this is an example. And I think as you said, in a perfect world, you would have all of this information to be able to do this analysis, but it is not a perfect world. And if we were to go back to the last slide, there are other ways to support a market conditions adjustment other than just doing a graph that matches this in some shape, form, or fashion.
Yeah, and absolutely. And if you're in like a niche market or a low density market and you don't have enough data, let's say you're in the condo market in a small metropolitan area that has relatively few condos. Maybe the best you can do is a year over year trend. Like, okay, that's the best you can do. That's acceptable. You're not going to have enough data to derive a month by month. Fine, give us what you have, right? But abdicating and saying, well, my data is thin, so I'm not going to do the analysis and I'm not going to draw any conclusions and I'm always going to make a zero adjustment. That's just not acceptable. Like that's not the way to do it. You take your best shot at it and then you tell us where the chips fell, right?
And that's where the judgment, the analysis done by the appraiser comes in. That's part of the reconciliation. Here's what I did. Here's why I did it. Here's what it means. And we don't always have perfect data. Let me ask you this, Lyle. If I'm in a market where there's not a lot of information, and I do an analysis that includes a graph of some variety, and my outcome, from looking at that graph is either just not usable, it's uncertain, or it's counterintuitive, what do I do then?
Well, I'm gonna share an analogy with you. How many of you have ever watched like these stock picker programs or these, New York Stock Exchange analysis business programs? You'll get these guys on there who are stock price analysts, and they'll talk about price per earnings ratio, and they'll as one unit of compare, right? And for its class, this particular company is earning more per share than its competitors, so that means that the stock price should go up, right? Or maybe they'll look at growth rate and they'll say price per earnings isn't the best metric here because this is a growth business and it's growing fast, and so it's really future earnings that matter, not current earnings. And then they have a bunch of different techniques which are really appraisal techniques, and they're very similar to the kinds of techniques that you would use to appraise real property, that they're applying to this stock, and they're getting not one answer but like several answers. And where the stock picker really earns their pay is by going in and looking across these various techniques and telling the audience why they think this one should be given more weight and why they think this particular piece of, the company is, has a pending lawsuit. Well, that's something that doesn't show up in the metrics, right? And they have a big risk there that they might lose money. Okay, factor that in, right? This is what appraisers should be doing. You're using however many techniques are appropriate for your time adjustment, and by the way, for any of your adjustments. And then you're saying, oh, but by the way, the main employer in this company in this city just announced a hiring plan. They're going to grow, right? That should stimulate demand. Or I'm using an HPI, but that's at a state level. I'm also using paired sales, and that's like at a local level. And I'm also using the statistical analysis, and that's like a metropolitan level. I like the local better. I think that more granular approach is better, or whatever, right? You're going to have to use your judgment. It's data informed judgment. It's not just witchcraft, right? But you're going to take what you know about your community and your market, and you're going to apply it to these different results, and you're going to tell us which one you trust more and why. That's analysis.
And that brings us back to reconciliation. This is a reconciling of these techniques to come up with a supportable adjustment we're talking about time adjustments right now, but for whatever the adjustment is, that's what we do as appraisers.
That's right. And you're going to find this will be a common experience. I won't even call it a problem. It is how the world works. And it's common for all valuation experts, whether it's your stock picker or whether it's your real property expert or your art appraiser. It's common to all valuation exercises that you're going to get a range of answers using different techniques, and the expert is the one who tells us which technique is most appropriate for this situation given the context, right?
Yeah, I like that analogy. That makes it pretty clear. And I want to make clear here, and you and I did not discuss this beforehand, but we're talking right now about market conditions adjustments, and we're talking from our recent experience. It has been a growing market. These same principles apply if the market is in decline, is right.
Okay, I'm glad you brought that up, and that is super important to us because right now, if the market's appreciating and you're underestimating because you're not doing time adjustments, while that's wrong, it's still kind of safe. That's a conservative position. So it's safe for Fannie Mae for you to underestimate the value, right? The opposite is not true in a down market. In a down market, if you overestimate because you're not making time adjustments, you're putting us at serious risk. And this happened in 2009, 2010, right? We have a historical experience of this. So we're trying to change the culture around time adjustments, starting with the lender and the underwriter, and hopefully extending that to the appraiser before we get into any down markets. I'm not predicting a down market. Maybe we'll continue happily on our way for eternity, but the American economy has always been cyclical, right? You have to expect that at some point there will be a downturn, and these principles become super important in a downturn.
Yeah. Yeah, and thank you for clarifying that, because we've been talking for the past few years about market conditions adjustments, and it's always showing an upward trend. That is not necessarily always the case, and I do take the point that right now, if I, as an appraiser, miss a time adjustment, it's not necessarily putting you in more risk. It might even be safer for you. But if I'm missing a time adjustment in a declining market, then I could be putting you in a lot more risk.
Exactly.
Okay, good. All right. Anything else you want to talk about this slide before we move on? No, we've moved on to explain the adjustments.
Moving on to explain the adjustments. We've talked a lot about this already, but I'll just focus on, first of all, on the right, a statement only recognizing that an adjustment has been made is not acceptable. And similarly, recognizing that an adjustment was not made is not acceptable. And I see this all the time in appraisal reports. Appraisal will come in and say, I adjusted $10,000 for a bathroom and $5,000 for a garage bay and $30,000 for the golf course view. That's a statement.
Right.
I can see your adjustments in the grid. I don't need you to restate them in your reconciliation. That's not support, right? Support is the why. Why did you adjust $30,000 for the golf course? Why did you adjust $10,000 for the bathroom? What's your evidence for that rate of adjustment? That's the statement that we need. Okay.
Okay. All right. Fair enough.
Now on the left here, we've got a bunch of newsletter articles that touch on the topic of adjustments and supporting adjustments. And so that's a good resource for you. I don't know how many of you know, Fannie Mae publishes a quarterly appraiser update newsletter. It's usually maybe 3 or 4 pages long, 5 or 6 on a bad month, a long month, right? And so it's a pretty quick read. It usually has 4 or 5 little articles about hot topics in the appraisal space. And so we've touched on adjustments on a number of different occasions.
And I want to jump in real quick for the folks listening. If you're not aware, if you go to fanniemae.com, you can find all of these resources Lyle is talking about, including you can navigate your way to the selling guide and get the actual guidelines that Fannie Mae is publishing. But these newsletters are available to us as appraisers through fanniemae.com.
And we have a lot of contributing authors in our newsletter from across our appraisal team, but I'm sort of the editor. I combine them all and do the final edit check. So you'll see a little bit of my sort of stamp on this stuff, and I'm really proud of it. I think this is a great resource for appraisers. That's our goal anyway.
Good. All right, we are sitting on top of the slide that says Q&A, and we have a number of questions in the Q&A panel that I have in front of me. Before we do that, Lyle has mentioned a couple of times education, learning all of the techniques that are available to you as an appraiser. You can click over to appraisereLearning.com. If you use this code AEL15, you'll get 15% off. We have some classes coming up. One in particular is a course on objectivity. It's a 4-hour course taught by Scott Cullen and Tim Anderson, 2 instructors that can help you understand the fundamental statistical business going on when you're looking at being objective and making adjustments properly. We also have courses from Brent Bowen and Steve Kahane that are really good on specifically addressing market conditions adjustments. Check it out at appraisereLearning.com. If you use AEL15, you'll get a 15% discount. All right, so Lyle, brace yourself. We have a lot of questions here. On the screen, you'll see that Lyle has put up a slide that has a scan me. You can get to some of the resources there. Also, it's fairly easy to navigate to fanniemae.com and click around the website and get familiar with some of the things. So I'm going to go through some of the questions we have here on the Q&A panel. The sample provided showed a graph with various up and down movements in the market over the 12 months. It appears to require 12 data points to be analyzed with different selling seasons. How can we expect to be so precise when the markets move seasonally?
I mean, it's a fair question, right? Not every market will have that granularity of data. And just to be clear, doing it a month-by-month basis is not our requirement. It's the ideal. And if you could achieve that, that would be fantastic. You could even, I mean, if you had enough data, you might be able to do a day over day, 365 day adjustment cycle, right? So it depends on how much data you have and how granular that data is, how consistent that data is, and how good your techniques are. But the expectation is that not that you will create this graph or that you will have a month over month analysis. It is that you'll do a market conditions analysis that will lead to a determination of adjustment rates. And that will be dependent upon the amount of data that you have and the kind of data that you have.
Okay. And that's a good segue into this next question. Is it now acceptable to base time adjustments on an analysis of macro level market data as opposed to an analysis of available comparable data?
Yes.
Short and simple, yes. The home price index example that you gave is I think, just repeat that for us again. If I have had nothing else available, can I use that as some support for a time adjustment?
Yes. If that's the only thing you have, then that's what you have, right?
Okay.
And that would be acceptable. Now, I would say you still have to put on your thinking cap, right? So we could come up with all the counter examples. Let's say you have a statewide HPI and things are just roaring along, but you happen to be in a little niche community where all the major employers have closed and everyone's leaving town. Okay, you might buck the trend, right? And you need to analyze that and reconcile to that. So the HPI isn't something, it's just like any other tool. You don't want to take it on blind faith. You need to apply it to your circumstances.
Right. Question from Mark B. Why not revise the now retired Fannie Mae 1004 MC addendum to be able to call time adjustments from?
Well, we did think about that. Most appraisal software packages still have that 1004 MC. So if you wanted to use it to communicate your research, that would be fine. What we found in actual practice is that it didn't yield reliable results. And there's a lot of reasons for that, but just requiring that addendum didn't improve our outcomes any.
All right, let's see here. All right, this is a good one, and this goes back to the underwriter education piece that we're talking about. And I think that's going to be part of what needs to be done going forward is actually outreach to the lender side of this equation to help underwriters understand the process a little bit better in some cases. But what do I do when the lender won't accept a negative MC adjustment for one or more of my comps?
Well, one thing you could do is cite our selling guide references to time adjustments. We've tried to make them into kind of useful snippets that you could put in front of an underwriter and say, look, Fannie Mae is requiring me to do this. The second thing that's really important, though, is you have to have a sound data argument so that when they see your argument, it makes sense to them and that they're able to follow it and naturally come to the same conclusion you did.
Okay. I had a conversation last week with an appraiser, and they had talked to another appraiser. So I know I'm like doing triple hearsay in this, but the appraiser said in their report, I show a market conditions adjustment of plus or minus 8.7%. This is such a minuscule percentage. I'm not going to apply a time adjustment for this. What is your take on that?
Well, if you know that there is a gap between the evidence that you have cited and your final conclusion, then you need to find a way to close that gap. I do think that the appraiser is going to have to exercise some judgment. Like you're going to have different samples and different techniques are going to produce different results. And that spread of or range of possible outcomes is something that you're always going to have to grapple with. If your default is I'm always going to go to 0 because I'm uncertain, then that's not going to work.
I guess from my perspective, when I'm talking to appraisers about the percentage time adjustment or the percentage market condition adjustment, and someone says 8% is really not enough to adjust, or 8.7%, which could be rounded up to 9%, is not really enough to adjust for.
I thought you were like 0.8. I'm sorry. Yeah,
no.
8% introduces a huge error, doesn't it?
Yeah, I think it does. And
Yeah.
when you look at let's just take a $250,000 house, for example, an 8% adjustment on that house would be $22,500. And the appraiser is making
an 8%, intentionally introducing an 8% error really invalidates the whole appraisal process.
Okay, so if we've got 8% or 9%, it's clear to see that's a fairly large number. And if we're looking at $22,000 plus or minus dollars based on an 8% adjustment, and I'm adjusting for a fireplace at $5,000 or whatever the number is, like that starts to be to feel less credible to me as an appraiser and as a reviewer. But if I've got 0.8% or 1% change,
that's a little different, right? So I would take it this way. On a typical appraisal, when I look at lots of appraisals, right, a typical range of adjusted sale prices. So you've got 4 sales comps. You've adjusted them all. You look at your range. A typical range is maybe a little less than 10%, right? If you have really clean data, you might have a range of less than 5%. If you have really ugly data, it might be a 20 or 30% range. It just depends on the nature of the property and the surrounding properties. But I would say less than 10% is pretty typical. So if your total range of possibility is 9%, and then you say, I'm not going to make a 9% time adjustment that the data warrants, you've just doubled your error, your intrinsic error.
Okay. All right. Here's a good question from the field. This is in the Q&A. And if you have questions for Lyle Radke, not for me, for Lyle Radke, feel free to post them in the Q&A. They will either be answered by one of the folks in the answering room, or they will be forwarded up to us to answer. But here's a really good question. Lyle, should evidence, example paired sales, be included in the appraisal report or retained in the work file?
I would say included in the appraisal. Well, of course, both, right? It has to be in the work file. It should be in the appraisal report. And if it's in the work file, how hard is it to put it in the appraisal report? It's just copy and paste, right?
I've seen some people make the statement, if they want me to put this stuff in my report, I'm going to have to charge more. And I've never fully understood that, because if I've already done the work, it literally is a cut and paste. Here's the support for what I've done. I think that's a fair thing to point out.
I want to just touch on that charge more question real quick. There's nothing wrong with charging more. I want to take you back to slide 3 where we talk about Fannie Mae's mission. We need the value to be right.
Yep.
If you're cutting corners to keep your price down, it becomes a throwaway. Why do we want your appraisal if it's not going to help us solve our risk management problem?
So this question is not from the field, but it's one that I've heard on a number of occasions. I'm an appraiser.
Charge more, do more, and charge more.
Yeah.
Earn the money. You deserve it. Take the money. And if
an appraiser,
all of you raise the bar together and you all charge more, lenders will acquiesce. What choice do they have, right?
Yeah, absolutely. And the counter to that is, well, there's always somebody out there that's going to do it for cheap. Here's the thing.
And you know what? We're trying very hard to catch people who cut corners. So that's a whole different topic. But, the people who are cutting the corners are putting their business at risk from an enforcement perspective.
Yeah. So the question I've gotten several times, and this, I'm not going to get terribly specific, but I think it requires getting into the topic a little bit. I'm an appraiser. I'm out there working. I've got an AMC client that I've worked with for a long time. They're telling me, don't reconcile outside of the closed sales price range. We don't want to see time adjustments that are too big or whatever. It's above the 25% threshold for a single adjustment, whatever it is. These are old regulations. How do I, as an appraiser, educate that client about, I have to do this?
We published a lender letter back in 2015 that breaks this down for lenders, that tells them there is no 25% gross adjustment cap. There is no 15% net adjustment cap. There is no 10% line item adjustment cap. Those are fables. They don't exist. Stop asking about that. And at the same time, we rolled out collateral underwriter, which I know collateral underwriter is sort of like the hated monster for appraisers, but it's actually your friend. You just don't know it because collateral underwriter is intended to educate underwriters as to good appraisal practice. And when you follow good appraisal practice, you're going to look good in collateral underwriter. And then that's going to reduce questions from the underwriter if they're using it correctly. So for example, collateral underwriter all day long will make gross adjustments above 25%. All day long, it makes net adjustments above 15%. The principle here is you analyze the data and you go where the data leads you. There's no artificial limits. You just simply follow the data.
Yeah. All right. So another question from the crowd. Richard D asks, if closed sales indicate a stable market, but active and pending listings indicate movement, should the appraiser calculate time adjustments using the listings? This is common in my seasonal market, particularly for new construction, as prices jump quickly in the spring and then drop quickly in the fall.
Yeah, I think that's a great technique. That's great supporting evidence. So by all means, absolutely yes.
I have an appraiser friend here in Nashville. He was one of my mentors, and he had some time adjustments during the COVID boom when things were going up fairly rapidly, and he got pushback from a client. And what this appraiser did is he called some real estate agents that he uses on a regular basis to verify sales, and he got copies of active and pending contracts redacted, so nothing specific was identified, but he included those in the report as support.
Yeah, I mean, there's a lot of space for creativity here, but that is the kind of thing that you should, as the local market expert, that's the kind of thing you should be trying to do. And I'm not saying you have to do that specific thing, but interviewing agents is great technique. Measuring list to sale price ratios, measuring days on market. If there's an acceleration, like for the last quarter, the average days on market in your market was 50 days, and now in this quarter it's decreased to 30 days. That market's accelerating, right? That's evidence of an upward trend. So any and all of this evidence is great for supporting your market change analysis and your time adjustment.
Great. Let's see here. Thomas D says, your graph shows nearly straight line movement when Fannie's example shows up and down movement in the past 12 months. A yearly change is easy to adjust. However, up and down movement throughout the year makes this significantly more difficult. Please clarify.
Yeah, you caught me, right? So the straight line graph was something we put together relatively easily just for exhibit purpose, right? Just to try and illustrate the issue. There's lots of other ways you could construct that example. So don't take either of these charts as being gospel of what you need to do. Again, we're not trying to over micromanage this. What we're saying fundamentally, the problem is on a very large number of comparables, there are no time adjustments being made. And when time adjustments are made, they're often lagging whatever analytics we have suggest that it should be. And so we want appraisers to do the market conditions analysis. And if you find evidence for market change, be bold, make the adjustment, right? Go strong, right? But it's still up to you. You're still that expert, and there's lots of techniques. You're going to choose your technique. You know your market. You know what data you have available. You're going to have to make do with what the data is that's available to you. You can't just invent data. Ideal data doesn't always exist. So you have to. I like that question. The couple questions ago where he says, "I'm interviewing real estate agents. I'm getting copies of contracts. I'm looking at pending sales and days on market." Like, this is all appropriate. These are all good techniques. So learn the techniques, learn to apply the techniques where appropriate. It's your job to figure that out, but don't abdicate that. Do something, right? Do something credible.
Yeah, and at the end of the day, I used to work with an MAI here in Nashville by the name of Mike Ishii, and he would say, if you know you're going to get a question, explain it very well up front. This is letter avoidance.
The HPI graph is the question. Like, my HPI says the market changed 10%. You didn't make a time adjustment. Why is that?
Right.
Okay?
Right.
Anticipate that question. It's okay to say, hey, the HPI is wrong, and here's my evidence to the contrary. That's the right answer, right? Show me your evidence.
Yeah.
And it's okay for you to go somewhere else based on that evidence. But you should expect the question, right?
All right, I've got a question here. This appears to be from a lender. How much should we as lenders push back on appraisers that dig in and say they don't have enough data to make an adjustment?
Well, I think based on what we've talked about today, there's always data. It's a question of whether or not it's good data, reliable data. But I would also say a zero adjustment is an adjustment. So if you don't have enough data to make an adjustment, you also don't have enough data to defend a zero adjustment.
I had a conversation day before yesterday with an appraiser who said, I've got plus or minus $4 million homes. There are precisely 4 transactions that are comparable to this home in my market area. I just don't have enough information to make any adjustment for time adjustments because I've only got 4 data points. What might be a workaround for that?
So I think there's a lot that I don't know about this scenario, right? But what I would consider, the first thing that comes to my mind is go back further in time. So you say you have 4 sales. Is that in the entire history of your community, there have only been 4 sales? In which case, this maybe is sort of an outlier property. How do you do any of your other adjustments if you don't have, if this is how thin your data is, right?
Right.
So I think that's a problem. But so go further back in time and do time adjustments that are longer span. Instead of a month, maybe you're looking at a 2-year over 2-year rate, right? And then extrapolate from there. But you could also expand your geography. Like, people who will buy a $4 million home, if you're in a community where there's very few of those homes, it's probably true that those particular kinds of buyers might look in wider geography. Nobody's going to limit their search to just 4 houses, right? So expand your geography, and if you can find trends in a competing community, apply those here, right? So I think there's ways to sort of extrapolate from a broader data set, expand your data set.
Okay, I like that. All right, so we've got one from Rebecca R. Lyle. How are we going to train new appraisers with so many waivers, aka value acceptance, being used for conforming properties? It's very difficult to train someone on complex and unique properties. Any ideas? Help.
Well, the Fannie Mae has offered a version of appraisal waivers, some version of appraisal waivers for 27 years, which is almost my entire career. And yet somehow I got trained, right? The offer rate is not very high. Most loans still get appraisals. There's plenty of opportunity for appraisers and for new appraisers. So I wouldn't worry about that.
Okay, very good. Lyle, I think we have exhausted the Q&A questions that have come into our chat window here. We have overshot the runway on timing. We're 5 minutes past what we had planned on. Lyle, thank you so much for your time. There are a lot of things that we could discuss and go on discussing all day, including the upcoming UAD implementation 3.6, the new UAD. Anything you'd like to say before we call this to a close?
Yeah, I want to say this. Sometimes appraisers maybe feel a little embattled, right? I have an old saying, it's easier to critique than it is to create. Another old saying is everyone's a critic, right? It's very easy to point fingers and say, you're not doing it right, but it's much harder to be the creative engine that figures out how to do it. And when we look at overall the body of appraisals that we see, that we receive, most appraisals are really good, and most appraisers are doing a great job. We offer value, rep, and warrant relief on more than 70% of the appraisals we receive. We're basically telling lenders, hey, this one's good. Don't worry about it, right? And our defect rate is less than 1%, and substantially less than 1%. So I just want to encourage appraisers a little bit. The sky is not falling. It's not all doom and gloom. I think there's a bright opportunity for a bright future for appraisers, lots of opportunity for appraisers. We rely on appraisals. We love appraisers and appraisals. So let's not lose sight of all the good that appraisers do just because, maybe we could do a little better. Maybe there's some things we could improve upon. And it's fair to say, let's try to get better at time adjustments. That doesn't mean everything else you're doing is bad, right? So.
Yeah, I like that. Thank you for saying that, Lyle. That actually means a great deal to me as an appraiser to hear that message. And to the point of the sky is not falling. This morning, I talked to two appraisers, one here in Nashville, one out in Washington State. The Nashville appraiser has just opened a new office and is hiring staff appraisers to work with him. The appraiser out in Washington State for the past 2 months has been getting upwards of 16 orders per week. The sky is not falling. Are there changes coming? Yes, there are. If you are concerned about how am I going to deal with this new non-form report building process, the new UAD, I've got a couple of options for you. We would be tickled if you would join us in Las Vegas for Valuation Expo, August 11th through 13th. There is an offer up there on the screen. You can click register now to join us in Las Vegas for Valuation Expo. We will be teaching the UAD class there. If your schedule allows, coming up very quickly next month, April 5th through 9th in San Antonio, Texas, Appraiser eLearning, along with the NAA, will be hosting yet again the Appraisers Conference and Trade Show, the ACTS Conference. There is a button there you can register for the Appraisers Conference and Trade Show. We will be delivering the new UAD training put together by Fannie Mae at that conference, live and in person. I believe Brian Reynolds will be teaching that class. Join us at one of these conferences. Hear straight from the horse's mouth what Fannie Mae, Freddie Mac, and the other people that order and consume appraisals want from us as appraisers. Lyle, thank you again so much for taking the time to be with us here today. I think this was incredibly useful.
Yeah, thank you, Hal. And I'll be at ACTS and looking forward to it. Fannie Mae will have a booth, and I'll hang out there if anybody wants to come meet me, and we can talk more about these things.
Fannie Mae will have a dunking booth, and you're going to be in it, and appraisers can throw...
Rotten fruit. Yes.
I love it. We would get a lot of people showing up for the conference if we did that.
Put that in your charitable fundraiser, right?
I love it. Lyle, thank you again. Everybody.